Every year, governments spend billions of dollars on something their citizens never see. Not in schools, not in hospitals, not on roads, on numbers in an account in New York, London, or Zurich. China sits on a war chest of more than $3 trillion worth of foreign exchange reserves. Japan has over $1 trillion. Tiny Singapore controls more foreign assets per person than most of the world will ever touch. Even countries drowning in debt still scrape together a few billion in dollars, euros, or gold and stash them away. And here's the paradox. If governments are always telling their people there's no money for basic services, no money for pay rises, no money to fix collapsing infrastructure, why are they hoarding foreign currency like a medieval king hoarded gold in a fortress? Why does a poor country build a war chest instead of building schools? And more importantly, what exactly are they preparing for? Foreign exchange reserves sound like a technical detail, one more boring line on a central bank balance sheet. But history shows something very different. FX reserves are the modern equivalent of fortified grain silos and royal treasure rooms. They are the emergency rations of the global economy. Every major crisis, every currency crash, every sudden panic in financial markets reveals the same pattern. The countries that survive with the least damage are not always the richest, not always the most democratic, not always the most productive. But they almost always have one thing in common: a war chest. Enough hard currency to calm the storm, at least for a while, but that calm is never free. Someone, somewhere, is paying for those rainy day dollars and euros sitting quietly in foreign accounts, doing nothing visible for the people who earned them. To understand why governments keep piling up these invisible reserves and what they're really afraid of, you have to go back to a time when the idea of reserves was painfully simple. It wasn't called FX, it was just treasure. For most of history, a state's reserves were gold coins locked in a vaulted room, silver bars stacked in a royal mint, chests of bullion guarded by soldiers. By the 19th century, under the classical gold standard, this treasure took on a new function and a new meaning. It wasn't just wealth, it was credibility. If a government issued paper money and promised that each note could be converted into a certain amount of gold, it needed enough gold in the vault to make that promise believable. The pile of metal became a shield. As long as the world believed that shield was real and solid, the currency was stable. If doubt crept in, if people suspected the state was printing more promises than it had gold to back, there was only one defense. Open the vault, let the gold move, and prove you could pay. Central banks shipped gold across oceans to settle trade imbalances and defend exchange rates. When things got rough, interest rates were raised sharply, borrowing was crushed, trade slowed, and ordinary citizens were thrown into recession, all to protect that pile of metal and the illusion of absolute convertibility. The war chest calmed the storm, but it did so at a price. The pain was local. The reassurance was global. Fast forward to the wreckage of World War II. The old system lay in pieces. Europe was ruined. Currencies were shattered by inflation and occupation. Only one country emerged with both industrial strength and a mountain of gold: the United States. When the Allies met at Bretton Woods in 1944 to design a new world monetary order, they made a radical decision. They put the dollar where gold used to be. Other countries would peg their currencies to the US dollar. The dollar itself would be convertible into gold at a fixed rate, at least for foreign central banks. And those central banks would hold their reserves primarily in dollars, bank deposits, U.S. Treasury bonds, and a residual layer of gold. On the surface, this looked modern and sophisticated. Underneath, the logic hadn't changed at all. You still needed a war chest. Only now, instead of hoarding gold bars, you hoarded claims on the United States. If your currency came under pressure, if foreign investors tried to flee, if your people demanded imports you couldn't pay for with your own money, you turned to that stockpile of dollars. You sold a little, bought your own currency, assured the world you could still honor your promises. Gold had been replaced by paper, but the fear was the same. Fear of a run, fear of panic, fear of being forced to watch your currency collapse and your middle class wiped out in a matter of months. That fear never left. In fact, it intensified. Because in 1971, when the United States suspended dollar convertibility into gold, the last visible anchor disappeared. The world moved into a new era of pure fiat money, where everything floated and nothing was formally redeemable. What survived was the habit. Central banks continued to accumulate reserves, now entirely made of paper claims and digital entries, because the lesson was clear. In a crisis, the country with a full war chest gets to make choices. The country with an empty vault gets told what to do. If you want to see how brutally that lesson was driven into the minds of policymakers, you don't start in Washington or London. You start in Bangkok in the mid-1990s. Thailand was a success story. Its currency, the baht, was pegged to the US dollar. Foreign investors poured in. Property prices surged. Stock markets climbed. The story was the same across much of East and Southeast Asia. Growth was fast, optimism was high, and foreign money was eager. Then confidence cracked. Speculators began to believe the baht was overvalued and that Thailand didn't have enough reserves to defend it indefinitely. They started borrowing baht, selling it for dollars, and waiting for the inevitable break. The Thai central bank responded the only way it could. It opened its war chest. It began selling dollars and buying baht, burning through billions in an attempt to prove that the peg was unshakable. But the math was straightforward. Each day of defense drained the reserves. Each dollar sold bought a few hours of stability at the price of reduced firepower tomorrow. Eventually, the war chest fell faster than confidence rose. When the stockpile was nearly depleted, the illusion snapped. Thailand abandoned the peg. The baht plunged. Dollar-denominated debts exploded in local terms. Banks failed. Businesses collapsed. The crisis spread to Indonesia, South Korea, and beyond. The Asian financial crisis of 1997 delivered a simple, brutal message to the developing world. Never again. Never again be caught with too little in your war chest. Never again be forced, on your knees, to accept painful conditions from the International Monetary Fund in exchange for emergency dollars. Never again allow foreign speculators to dictate your fate because you ran out of ammunition. So governments and central banks changed their behavior. They began to hoard. China, Korea, Malaysia, Russia, and many others shifted from deficit-driven growth to export-led strategies. They deliberately ran trade surpluses, exporting more than they imported, and used the resulting inflow of dollars to pile up reserves. On the surface, it looked like pure competitiveness, cheap labor, booming factories, rising exports. Underneath, it was also a quiet, deliberate act of self-insurance. National savings were being transformed into foreign war chests. FX reserves became a giant, expensive insurance policy against future storms. A country with hundreds of billions in reserves could tell investors, "You can leave if you want. We have enough dollars to absorb the shock." A country with almost none had to beg for help, strip away the jargon, and ask a simple question: what is actually inside this war chest? For most nations, especially in the developing world, the answer is surprisingly narrow. It is mostly US dollars and US government bonds, plus some euros, yen, and sterling, a small amount of gold, and perhaps a token slice of other assets. In practical terms, a country's safety net is a stack of IOUs issued by other governments, concentrated above all in the promises of one, the United States. Imagine a neighborhood where every family ES emergency savings are stored in the same neighbor and his basement. As long as that neighbor remains stable, everyone feels protected. If that house ever catches fire, the entire street burns psychologically, even if their own walls are untouched. In normal times, though, this structure works. When a storm hits, when foreign investors panic, when imports suddenly become expensive, the central bank can step in. It can sell part of its dollar stockpile to buy its own currency and slow a collapse. It can pay for essential imports, fuel, food, medicine, even when nobody wants the local money. It can reassure markets that it has enough to cover short-term foreign debts. In a panic, confidence is everything. Reserves are confidence made visible. They are the central bank stepping out onto the balcony, metaphorically opening the vault and saying, "Look, we can survive this. Not forever, but long enough." The power has limits. A war chest doesn't stop the storm. It buys time in the storm. And time, during a crisis, is the most valuable asset of all. You can see this clearly in the crises of the last 20 years. In 2008, when the global financial system seized up, the panic did not stop at Wall Street. Dollar funding evaporated worldwide. Banks outside the United States, which had borrowed in dollars to fund their own operations, suddenly struggled to roll over their debts. Currencies came under pressure. Trade routes trembled. Countries with large reserves and credible central banks could intervene, provide foreign currency liquidity to their banks, defend their exchange rates selectively, and reassure investors. They still suffered. Growth slowed, markets fell. But they avoided immediate collapse. Countries with small reserves had no such luxury. They watched their currencies tumble, their external debts balloon, and their banking systems teeter. Some were forced into emergency programs and harsh adjustments. The pattern repeated during the 2013 taper tantrum, when the U.S. Federal Reserve merely hinted that it might reduce its bond buying. Capital flooded out of emerging markets. The Indian rupee, Indonesian rupiah, Brazilian real, and others weakened sharply. Once again, markets drew an invisible dividing line. Those with large FX reserves were given the benefit of the doubt. Those without were punished. In 2020, when COVID-19 froze travel, tourism, and parts of global trade, demand for dollars surged again. Export earnings collapsed. Remittances fell. Oil prices crashed, then spiked. Once more, central banks opened their war chests. Reserves were sold to stabilize currencies, maintain import flows, and prevent panic from turning into systemic failure. The war chest did its job. It calmed the storm, just enough. But all of this raises a question most citizens never think to ask. Who pays for the war chest? A country does not wake up with $300 or $500 billion in reserves. Those dollars had to be earned, borrowed, or diverted from other uses. They can come from running trade surpluses, which means the country consistently ships out more goods and services than it brings in. They can come from foreign investment and borrowing, where inflows are partly parked as reserves. In every case, there is a cost. If a nation runs large trade surpluses for years, that often means its people consume less than they could. Factories work overtime to satisfy foreign demand. Domestic consumption is suppressed. Wages may be held down to keep exports competitive. The country lends real goods and labor to the rest of the world and, in exchange, accumulates claims on foreign governments. If reserves are invested mainly in safe but low-yield assets like U.S. treasuries, that money is not being used to build domestic infrastructure, improve education, or upgrade hospitals. It is earning modest interest, far below the returns that might be possible at home, but with one crucial advantage. It can be liquidated instantly in a crisis. If the government borrows in foreign currency and then parks part of that borrowing back as reserves, it is effectively paying an interest bill to hold liquid dollars as a show of strength. In theory, this is all rational. It is the price of insurance. In practice, it creates a cruel irony. Ordinary people are told there is no money for wage increases, no budget for better schools, no funding for social housing, all while their government quietly sits on a mountain of foreign assets, reserved not for them, but for the day markets turn hostile. Your present is sacrificed to protect the system's future. Not necessarily your future, but the survival of the banking system, the ability to pay foreign creditors on time, the political sovereignty of the state in the face of outside pressure, because that is what FX reserves really protect. They protect the government's negotiating power. A country with an empty vault has to accept whatever conditions creditors and international institutions demand. A country with a full war chest can say no, or at least argue harder. Sovereignty has a price. That price is paid quietly, through lower living standards than might otherwise be possible. And sometimes, even that price isn't enough. In the years leading up to its 2022 default, Sri Lanka's foreign exchange reserves dwindled. The country relied heavily on tourism, imported much of what it consumed, and borrowed in foreign currencies. When COVID-19 hit, tourist dollars vanished, debt repayments remained, import needs did not disappear. The central bank dipped into its reserves to buy time. For a while it worked. The currency did not collapse immediately. Imports continued, though increasingly rationed. But the arithmetic did not change. Month after month, reserves dropped. When they reached dangerously low levels, the illusion of control shattered. Fuel shortages spread. Long queues formed. Blackouts became normal. Eventually, the government was forced to default and seek help. The war chest bought time. That time could have been used to restructure debts, adjust policy, and prepare the public for necessary changes. Instead, much of it was spent pretending everything was fine. When the last meaningful dollars left the vault, the storm arrived in full. This is the dark side of reserves. They are a powerful tool, but they can also delay reckoning. Weak leadership often uses that delay not to reform, but to deny. A war chest becomes a cushion for bad policy. There's also a geopolitical dimension to all of this. FX reserves are not only defensive, they are a weapon of influence. A country with a massive war chest can intervene in currency markets on a scale that scares speculators away. It can extend swap lines and emergency loans to allies in crisis. It can withstand sanctions longer than a country with empty pockets. It can signal strength silently by the sheer size of the numbers next to its name. At the same time, concentrating so much of the world's war chest in one currency creates a strange dependency. When most reserves are held in dollars, parked in U.S. government bonds, the entire system is effectively placing a colossal bet that one thing will remain true. That in the next storm, the safest asset on Earth will still be the American promise to pay. If that assumption ever cracks, the calm provided by FX reserves could evaporate. Central banks are not blind to this. That is why some are quietly diversifying, adding more gold, increasing holdings of other currencies, experimenting with alternative payment systems, and striking regional deals to settle trade in local units. But history offers a warning here too. When everyone tries to rearrange their defenses at once, when every fortress is being redesigned while the sky is darkening, the risk of panic rises, not falls. The same war chest that once calmed storms can become the focal point of fear. If markets start to question the value of the assets inside the vaults, the race to the exits can be brutal. Strip away the layers, and a simple truth remains. FX reserves are stored trust that these particular pieces of paper, these digital claims, will still buy food, fuel, and time when everything else is falling apart. They do work. History shows that countries with substantial reserves generally fare better in financial storms than those without. But they are not magic. They cannot compensate for chronic corruption, broken institutions, or economic models built on fantasy. They cannot permanently shield citizens from the consequences of decades of bad decisions. They can buy time. They cannot buy wisdom. For ordinary people, that leads to an uncomfortable conclusion. You will probably never be asked whether your country should hold $100 billion in reserves or spend a fraction of that on better schools, modernized infrastructure, or reduced taxes. Those choices are made far above your head. You will feel the constraints, but not see the accounts. And yet, when the next crisis hits and headlines scream about plunging currencies and capital flight, one phrase will appear again and again: the central bank has sufficient reserves. In that moment, those quiet, invisible numbers in foreign accounts will suddenly become the difference between controlled pain and uncontrolled collapse. That is why, when politicians boast about record reserves as proof of their genius, or condemn them as idle money that should be immediately spent, both miss the deeper reality. FX reserves are neither a magic shield nor a useless hoard. They are a bet that the next storm will look enough like the last one to make the same defenses effective. A bet that the assets in the vault will still be trusted when panic spreads. A bet that the time bought by that war chest will be used to fix underlying problems, not postpone them. Sometimes that bet pays off. Sometimes the war chest opens and behind the numbers there is real resilience. And sometimes all it reveals is how fragile the system always was. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.